Thank you so much, everybody, for being here tonight. So this paper is going to be about the role of people with socioeconomic status, and by that I mean their income and their education, on their macroeconomic expectations. When I say or rather than saying the word socioeconomic status, I'll say SES. So I'm just going to use that acronym. What do we know about beliefs, macroeconomic beliefs? Well, one thing we know about them is that they're different across people. And this has been documented by many papers already. If you look at surveys measuring expectations, not everybody says the same thing about what they think is going to happen to things like unemployment and business conditions down the road. And the fact that there exists heterogeneity in expectations about the macroeconomy, this actually has big implications, theoretically speaking, for asset pricing and macroeconomic dynamics, and there's a set of nice papers that document that. Now, what we do not know is why exactly is it that people differ in the expectations about macroeconomic outcomes, and this is where our paper fits in. We're trying to deliver to you one source of this heterogeneity, and this source is people's SES, socioeconomic status, that is their income and their education. Why would we expect that income and education, people standing in society, why does that matter for their expectations? Well, we have a little bit of evidence that ought to be the case. And I'm going to actually give you the first little bit of evidence. Is from a paper that's quoted here by Hansen et al. In 2015. It's actually a paper in a neuroscience journal. And it shows that if you take young adults and bring them to the lab and give them tasks where they receive rewards and punishments, individuals who as kids grew up in adverse economic conditions, they respond differently to rewards relative to individuals who did not have a lot of economic adversity growing up. And you can look at this at the brain level. Literally, the brain of people who as kids saw a lot of economic adversity, the brain of these people doesn't register rewards, good things, as strongly as the brain of people who did not see a lot of economic adversity growing up. So this tells you the implication from this neuroscience study is that maybe people who have seen a bunch of economic adversity will view the world differently. They'll end up viewing the world in a more pessimistic lens than individuals who've not gone through a lot of economic adversity or difficulty. And I have an experimental paper that's also quoted on this slide that was published in 2017, where in an experiment where we can control the information set about financial assets, they're of an experimental nature. But we control the information set about these experimental assets. We observe that individuals who have grown in economic adversity end up forming different beliefs about the quality of these financial assets than individuals who did not see economic adversity. And in particular, people who grew up with poverty end up with pessimistic beliefs about the quality of these financial assets. Again, this is an experimental setting where we can control the information set about these assets. You give everybody the same data about the dividends paid by these things. You give them the same prior beliefs, and you see that they end up with different expectations about how good these investments are. If you grew up in poverty, you are more pessimistic. Now, this is an experiment, and not everybody believes in experiments. And so it's important that we show that this finding has external validity. That is, that in the large population, if you're somebody who is coming from a more adverse situation, somebody of a lower SES, that you do form these more pessimistic beliefs, and not just about financial assets, but about the economy in general. Maybe this is what we're going to see in sort of a sample outside of the lab. And this is where the current paper fits in. So we have data from the Michigan Survey of Consumers. It's over 37 years worth of monthly data. Every month we have data for about 400 individuals across the entire country. So it's a lot of data. And for these people, we measure several aspects of their macroeconomic expectations. We also are able to see for these people proxies of their choices. So eventually we'll be able to link their beliefs, part of those beliefs coming from the SES channel. We can link that to these proxies for their choices. And so in this large sample, we show basically what the experiment showed, that lower SES individuals are more pessimistic. And because of this pessimism about macroeconomic conditions, they'll end up investing less in stocks. They'll be less likely to want to buy homes, durables, cars, and so forth. So this is where we are. Now, if you don't want to think about the rest of the presentation, if you want to close your eyes, what I want you to remember from this is, if it is indeed the case that these people with lower SES think about the macroeconomy in a more pessimistic lens than everybody else, this has implications for their welfare. They're not going to be in the stock market. That's a big loss. This also has implications for how wealth inequality in the population over time will vary. right? And it sort of suggests that over time you'll see more and more inequality. But also it has implications for things that we don't study in this particular audience, but are quite important. Things like investing in your education, investing in your human capital, investing in your businesses. If people of a lower SES are more pessimistic about what the world or the economy can offer to them, they will be making fewer investments in these very important things that are not necessarily financial assets. This is something we cannot talk about directly in this particular paper. We don't have data on this, but I think it's something worthwhile thinking about for future work. All right. There's a literature on how expectations might depend on people's circumstances, and I am sure all of you are familiar with the papers by Malmendier and Nagel, but just to refresh your memory, if you grow up in a cohort, so everybody who's born the same year, if you experience tougher economic developments, then down the road you end up, for example, looking like in your portfolio that as if you were avoiding riskier financial assets. So there are these cohort effects. This particular paper is not about cohort effects, it's about your income and education relative to the rest of your cohort. So it's your situation, it's not a cohort effect that we're documenting here. All right. Before I show you the data, I wanted to just put down a framework, a theoretical framework. It's not something that we came up with. You can think about other models that really they're sort of subtle variations along the theme that I'm going to show you here. And all of these other models probably will sort of match what we'll see in the data in a few minutes. So the model that I'm going to talk about right now comes from Gennaioli and Shleifer, is this local thinking idea. And the idea here is that when people try to forecast things in the world, they're going to put weight on information that comes to their mind, that this information is the type that's more representative for their situation. So they're going to ignore things that are not as representative for their own, or given their own personal history. And so let's pretend that we are dealing with these local thinkers. Some people in the economy are these local thinkers. And so in particular, we're going to think that the lower SES individuals are those who are more likely to be local thinkers. And there is some evidence from other papers that would indicate that poorer people are those more likely to consider just a little bubble around them when they think about the world. Now, if this assumption is not correct, then of course the data will not match the predictions of this little framework here. So the fact that I'm putting it up here means that it matches what the data will show. All right, so we have this local thinker who is a low SES person. And so what this means is, when they're trying to think about where the economy is, if the economy is it in a bad state, an okay state, or a good state, and this is a latent variable. We don't know exactly what it is, but again, it could be bad, okay, or good. This local thinker pretty much ignores the possibility that the good state of the economy could arise. Now, people get signals, everybody, these local thinkers and everybody else, we get signals about the economy, if it's in which state of these three it could be. But again, the point is that the local thinker is going to ignore the possibility that the good state could arise. What this means is just basically, there's not much math here really to go through. It just means that the local thinker, the low SES person, will be always more pessimistic relative to the high SES person who's not a local thinker. That's one implication. The second implication is that the wedge in expectations between the low SES people and the high SES people, this wedge will be particularly high in good states of the world, of the economy. Why? Because in a bad state of the world, ignoring the possibility following a bad signal, ignoring the possibility that the world could be good, that's not very costly, okay? Because it's unlikely that the state actually will occur. And so in good states of the world, or following good signals, I should say, the wedge between the beliefs of the low and high SES people is going to be the highest. And then also the third implication of this little story here is that the low SES people will be the furthest from rational expectations. Higher SES people will kind of match these expectations that are correct more so in the data. So this is our framework. And again, you guys can think about variations on this, maybe thinking about signals having different precisions across low and high SES people, but they probably will boil down to something similar to what we have over here as implications. All right, let's go to the data. Like I said, it's coming from Michigan Survey of Consumers over almost 4 decades. Every month, 400 households roughly from all over the country. And we're going to look at people who are the age ages of 24 to 75 years old. We know their income and education level. We also know their expectations, and I'll go through a few of those in a second. And we have these proxies for choices. Now, these are survey-based choice measures or behavior measures. You may not believe them. So people are asked, do you think it's a good time to buy a home, to buy durables, to buy a car? They give an answer, yes, no, maybe. Are these choices just, or what they tell you, just complete noise? The answer is no, and this is work done by many people, including Chris Carroll, who shows that these answers to these questions actually predict what's going to happen down the road in terms of aggregate demand for homes, durables, cars, and so forth. So this is, I'm just trying to say that the survey data cannot all be noise. Could there be noise at the individual level? Yes, but in aggregate, the Michigan Survey of Consumers actually provide us with some meaningful data that could predict future macro outcomes. Okay, so the measures of expectations that we're going to look at here are 5. One of them is this thing called PSTK, it's the probability P, that the stock market in the United States will have a positive return over the next 12 months. So right now, I'm asking the respondent, I'm calling him up, and I'm asking, what do you think is the chance that if you were to invest, sorry, it's actually, this is important. What do you think is the chance that $1,000 invested in a diversified US mutual fund will be worth more than $1,000 in 12 months? This is the question asked by Michigan. So it's about the probability that the stock market will have a positive return. It's a probability number. It's between 0 and 100%. So that's one question. The other questions are more general about business conditions. So for example, I have a text here for business expectations. How about a year from now? Do you expect that in the country as a whole, so this is important, again, this is not about your personal situation or your county or state. It's in the country as a whole. Business conditions will be better or worse than they are at present, or just about the same. So the answer is going to be either better a year from now, about the same, or worse a year from now. Another question is about unemployment. How about people out of work during the coming 12 months? Do you think that there will be more unemployment than now, about the same or less? So three possible answers. And then there are two other questions. This is, they're labeled Business 12 and Business 5. So in the next 5 years, do you think the country will be better, the same, or worse? And then this is for the next 12 months. So we have these 5 expectation measures, and we're going to standardize the answers to these 5 so that we can aggregate for one individual these 5 answers into one index of optimism. And you're going to see this variable popping up a lot. This is the optimism index. One thing to say here is that this PSTK variable, what is the chance you think that the market will have a positive return over the next 12 months? This is only measured starting in 2002. So you'll see that whenever I work in a sample that only focuses on PSTK, that the observations are going to drop dramatically because we don't have data before 2002. All right, so we have this optimism index. It's an aggregation of 5 standardized variables. If we don't have PSTK, then it's just an aggregation or average of 4 standardized variables, and that's okay. I'm also going to show you not just the optimism index itself, how it varies with SES, but I'll show you the pieces one at a time, so you can see that that's not just one of them drives the main result, but every single one works. So here's sort of the main result in a picture that would look even better if the top line here would be in red, which it is in the slides. You know, we have this red issue with this particular projector. So, but let me impress you nonetheless with this figure. So what I'm plotting here is just a simple average. Every single month, we split households, or I'm sorry, individuals who respond to the survey into income quintiles for now, just to show you the picture. But in the regressions, we'll do something finer than this. And so every single month, I'm going to look at individuals responding to the survey. I know their age. I'm going to put them in an age bin, 5-year age bin. So let's say like Brett here is in the bin between 25 and 29. And so relative to the other people in the country in that year, where does Brett's income stand? In which income quintile do I put him? Okay, so the quintiles are basically corrected for a cohort. And so I show here the time series for this optimism index about the macroeconomy for 2 quintiles. The picture would look very similar if I were to plot 2 other quintiles, one higher than the other. So the top income quintile is the solid line up here. The bottom income quintile is the dashed line down here. And what you can see without any analysis is that the top solid line, the beliefs about the macroeconomy of the people in the top income quintile, have always been above the beliefs, the optimism of the people in the lowest income quintile. Again, I could replace the lowest income quintile here with quintile 3. You would still see the same pattern. The people with higher income or have been more optimistic about the macroeconomy over time than the people in income quintile 3. The gap would not be as big, but there will still be a gap. But as you also can see in this picture, recessions do something to these expectations. The wedge between what the high income and the low income people say about the macroeconomy, that wedge dramatically diminishes in recessions. And hopefully you can see these gray areas here. These are NBER recessions. For example, in the last recession, you see how the higher income individuals, their beliefs converged to the beliefs of the low SES people. But then they bounce back up. So again, the point is higher income people have been more optimistic for the past 4 decades than lower income people, with the exception of recessions that basically are sort of a great equalizer in expectations. And you can see a similar picture if you look at split by education. It's sort of hard to tell because they're all black lines, but the solid black line represents beliefs of people with a college degree. The dashed line are the beliefs of people without a college degree. Same result. So if you have a high education, you're more optimistic, but not in recessions. If I show you now the picture just for the probability of the stock market as a positive return, so these are just beliefs about the stock market, it's even a bigger effect. So remember that I don't have this data before 2002, so the sample is shorter. We only have one recession here to talk about. But people in the top income quintile, on average, they say that the chance that the market will have a positive return is about 65% over the next 12 months. But the people who are in the bottom income quintile give you only about 35, 40%. So there's like a 20% gap in the beliefs about stock market returns, which of course has to mean something for these people's decisions to actually invest in the stock market. And you can see the same thing in terms of college education, the same sort of gap of, this is about 10% gap. People with a college degree just are more optimistic about the stock market, with the exception of this recession that we have in the sample. So that's kind of the basic result, or the main result of the paper, and I can show you this in the table. And in the table, we're controlling for year-month fixed effects, age, gender, marital status. Importantly, I wanted to say that we don't just look at the optimism index itself, but we split it in the components. So this is the belief about stock market return. These are the business condition questions. This is the unemployment question. So as your income rank goes up, and this number now is a percentile, so it goes from 0 to 1. If it's 1, it means you're in the 100th percentile of income given your age group in that year. So if your income rank is higher, or if you have a college degree, all of these belief measures indicate more optimism. But in recession, if you look at these interaction terms, you observe an attenuation of these SES effects on expectations. People become more similar in recessions. All right, so that's the basic result. Now, if you remember from the little model that I talked about, it should be the case that the people closest to rational expectations are the higher SES people. Lower SES people should make bigger errors. Why? Because they ignore the possibility that the good state of the world can occur. Do we see this? Do we see that the forecast errors are larger for lower SES people? And the answer is yes. Now, how do we do this? Who are the people providing the rational expectations? Well, I could have asked you for those expectations. You all should know them. No, I'm kidding. So the survey of professional forecasters, we think would provide the closest data to what we have about correct beliefs about what's going to happen down the road. And so we're going to use data from the survey of professional forecasters from SPF. And from there, we can figure out what the experts are thinking about business conditions and the unemployment rate. Now, you don't have data in the SPF about beliefs about stock market returns. For that belief, we're going to look at historical unconditional frequency the unconditional probability the stock market would have a positive return for the previous 12 months. And this is just the historical frequency with which 12-month windows of time yielded positive returns. So for those of you who've worked with SPF data, you know that you have to sort of maneuver or manipulate those answers about GDP levels to come up with GDP growth projections, or if you try to understand if they think unemployment is going to be doing better or worse than in the past, you have to just to fiddle a little bit with that information. So I'm not going to give you the details now, but we have a way to map our will the economy be better than now, the same as now, or worse than now? These sort of three answers that we have in the survey, we can sort of map whatever the SPF data say into these sort of three categories by doing some maneuvering of the data. So what you get in the end is that indeed people that have higher SES, and these are, let's look in this picture of SES measured by income, people in higher income percentiles in the distribution have been more closer to the truth, and by the truth I mean the beliefs of the people in the SPF, when it comes to the economic conditions as measured by real GDP growth. So people with higher incomes, their forecast tends to be closer to the beliefs of the SPF forecasters. The same is true about unemployment. So people of higher income provide unemployment guesses that are closer to the changes in unemployment that you'd observe based on the SPF answers. Whereas people of lower income are very pessimistic. They give you too high a number for unemployment. And then in terms of probability, the stock market will have a positive return. Here, everybody actually is, unconditionally, everybody is pessimistic. But the people who have higher income levels are the least pessimistic in the sample. So all this is to say that indeed, if you look at forecast errors, the lower SES people seem to make larger forecast errors. But now, you might not believe that the results that I've showed you so far, especially those correlations between SES and expectations, that they truly indicate that the person's social situation changes the way they view the world in a causal sense. And there's nothing that I can do here to really show causality. There's no way to vary exogenously somebody's SES, at least not that we could find in this large survey. But let me just give you a little bit more details to maybe convince you that there's something going on in the direction that we're predicting. So your situation will change the way you view the world. So one concern you might have that our story is not right is about us omitting maybe a personal characteristic that's sort of fixed. There are some people who are born pessimists, okay, and because they're born pessimists, they'll report pessimistic beliefs, but also they'll do things that'll keep them in a low SES situation. They're not going to get a job. They're not going to invest in the stock market. So how do we deal with that? Well, luckily for us, a subsample of people in the Michigan survey of consumers, they are asked to respond to the survey twice. So after 6 months, they're called up again, and they provide you again with answers about macroeconomic expectations and their income and so forth. And so we can use this subsample of people, and we can look at whether or not, if in the past 6 months, if their income situation has changed. College situation doesn't really change that often if you have or not a college degree for these people. But if your income rank has changed for the past 6 months, does that correspond with a change in your optimism index, right? So here you can take care of individual fixed effects. And indeed, we observe that if your income rank has changed, then you become more optimistic in 6 months. So it cannot be just that we're omitting this personal characteristic that's sort of fixed. Another concern, though, is this sort of reverse causality. So it's not that my SES will shift the way I view the world. It's because of how I view the world right now, not because of a personal thing that's fixed. Because the way that I view the world now, I will do things that eventually will make me poor and have low SES. Now, this is a little hard to agree with because, especially given what I just showed you here, this is a change it would have to be that your change in beliefs managed to change your income rank significantly in the past 6 months. So this reverse causality story is a little bit strange or would not really fit the data here. Another thing that's important is that to assess is whether or not there could be a spurious correlation that would drive the results here. So for example, I am somebody who's, you call me up, you're from Michigan, you want answers from me, and I'm gonna report to you very pessimistic numbers about my income and about the macroeconomy, okay? So that's just gonna lead to this correlation that we see in the data between my expectations and my reported SES. So how do we deal with that? So one thing we could do here, we can actually look at objective values for numbers that would tell you something about this person's economic situation. These numbers are things that we get from the census with respect to the unemployment and income in the individual's county at the time when this survey is done. So what I've done in this regression here is I've added data for county unemployment numbers. This is a monthly data that you can merge in. and then the county personal income. Unfortunately, because Michigan lost county identifiers before 2000, we can't do this merge for the entire data set, so the observations drop, the number drops a lot. But what you see here is that these objective measures of the person's situation, if they live in a county with more unemployment or in a county that has lower income, you're going to see they're going to be less optimistic in their expectations. All right, I think I have like 5 minutes left. Perfect. So the last part I want to talk to you about is about the effect of these beliefs that are driven by a person's socioeconomic status on their choices. Again, with the caveat that what we have here as choices are what these people report as their inclination at that time to buy a house, a car, or a durable good. So how do you figure out this effect, whether beliefs that are induced by your SES change your actions? How do we do this? Now, if I just showed you, so these are, let me first tell you about what we measure as choices. So I said earlier that we have these people's attitudes towards buying a car, durable goods, or a home at that point in time. But we also know if they invest in equities. So there's a dummy here, if you invest or not in stocks. And about 60% of the samples say that they do. And if they do invest, we have this variable called invest share. We define it as the log of the amount that you have invested so far, all through your accounts, scaled by your annual income. Okay, so we have a measure of whether you invest in equities and how much you invest. So these are our choice measures. So again, the point is that I want to illustrate to you is that SES matters for choices through this belief channel. If I just showed you that people that have higher incomes are more likely to invest in stocks, that would be fully not satisfying, right? So higher income, of course, has a direct effect on your ability to invest in stocks. Why? Because if you have higher income, you probably have a job that offers you a 401k that allows you to just, or even automatically puts you in equity, right? So there is a direct effect of income and a direct effect of education, not through expectations, but just through more mechanical things on whether or not you invest in a stock, or maybe your ability to get a loan to buy a home. So your answer to the question about buying a home today. So what I want to show you is that accounting for this direct effect, beliefs matter. So the way to do this is the following. You do what's called mediation or path analysis. So, and there's a complication here. Because there's measurement error in these beliefs, in this optimism index here, it could be measurement error, you can't just do what I'm going to tell you here with OLS. If we just do it with OLS, you're going to get some results that are similar. But if I were to just do this OLS, you would be concerned by a couple of things. You'd be concerned that because there's more measurement error in the beliefs than perhaps in the income of the individual, then maybe I'm not going to be able to properly measure the indirect effect of income through beliefs on actions. You might also be concerned, if I just do the OLS approach here, that perhaps there is common measurement error in both the optimism index, these beliefs about the macroeconomy, and what people report about attitudes towards buying homes and stocks and so forth. And so there might be a spurious correlation there. And so to step away from these issues, we're going to use an instrumental variable, and we're going to use again that sample of people who are repeated. They're surveyed twice, 6 months apart, and we're going to instrument the level of optimism that we see in these people at time t with the optimism that we saw in these people at time t minus 1. Just again to get away from these issues of interpreting the coefficients on the indirect channel. So again, how do we do this? How do I tell you how much of the effect of income on, say, investment is coming through beliefs? Here's the approach. So let's look at this table. This is the dependent variable is whether you invest or not in stocks. Over here, it is the variable that you're picking is the share that you're investing if you invest. Here, you're predicting whether the person would like to buy a home or thinks it's a good time to buy a home, durables, or cars. So let's look at this first column here. Income, right away, of course, has a positive effect on your probability of investing. This number here, 0.7, means that there is a 70% chance, there's a 70% difference in the propensity of people to invest in stocks if you're looking at people at the bottom of the income distribution and those at the very top, which makes perfect sense. So people at the top are way more likely to invest in stocks. Fine. So income has a direct effect on investment. But also you see here that optimism itself has an effect on investment, but optimism in part comes from income. So the total effect of your income level on your decision to invest, the total effect will be a sum of this direct effect and the indirect effect, and you obtain by the indirect effect by multiplying the coefficient in this regression where you're saying what's the effect of income on beliefs. You multiply this coefficient with that of the beliefs themselves on the dependent variable, the choice of interest. So I'm going to just show you a couple of numbers here. For example, if you look at the effect of income on your willingness to purchase a home, 25% of the effect of income on that decision to purchase a home is coming through the belief channel. If you were to look at the choices to invest in the stock market in particular, I can do the same exercise and use instead of the entire optimism index, just the belief about the stock market. So I can redo the same exercise, but just think about the stock market beliefs. And there you see that the effect of income on investing in the stock market, about 10% of that is coming from beliefs. The effect of education, for example, of investing in the stock market, 30% of that is coming through the beliefs channel. So this is, just to conclude here, people vary in their expectations based on their SES level. And the fact that these beliefs are so different actually has big implications for important choices, like investing in stocks or buying homes. And in the long run, this probably has an implication for how wealth inequality, for example, might evolve. Thank you so much.